Hi, in this class I am going to solve the 12th problem of income from house property. Let me explain the problem. Mr. Satish owns a big house and its FRV is rupees 40,000 and standard rent rupees 45,000. 25% of the house is used for own profession, 25% for own residence, 30% let out for business at rupees 2,000 per month and 20% let out for residence at rupees 600 per month. So here in this problem, SSC is the owner of a big house. So let this consider as a big house. So he is the owner of a single building which carries 4 parts. In that first part, 25% part of the house is used by SSC for own profession. If any part or if any house property, if it is used by SSC for a own profession, then it is not assessable under that income from house property. Second part, 25% for own residence, so it is considered as a residential house used by SSC. So this part is a self-occupied property. And the third part, that is a 30%, which is a let out property for rupees 2,000 per month. It is used by the tenant for business, not by the SSC. SSC used it as a let out property. And next part, last part, that is a 20%, which is also let out. And tenant is used it for residential, but SSC used it as a let out property. Owner used it as a let out property. We are calculating the taxable income for the owner, for the SSC, not for the tenant. So here SSC for which purpose SSC used, for which purpose owner used it as a let out property, and rent of that part is 600 per month. So big house has been divided into 4 parts. 25% part is used by SSC for own profession, and second 25% part is used by SSC for a residential purpose, and another 30% part which is used by SSC as let out property, and another 20% part which is used by SSC as a let out property. The big house is divided into 4 parts. Okay, let's see other details. First one, this portion was vacant for 1 month, means 20% part was vacant for 1 month. So there is a vacancy in case of fourth part or fourth house. You can consider these as a, say in case of 25% house, you can consider it as a first house. This is a first house, and 25% which is used by SSC for residential is considered as a second house, and 30% part is considered as a third house, and 20% part is considered as a fourth house. Now come to the point. Here SSC, in case of 20% part, SSC used it, there is a vacancy of 1 month in case of 20% part. And another point, the rent for 1 month could not be recovered due to the death of the tenant, and SSC satisfied the conditions. So the rent of 1 month, 1 month rent could not be realized in case of 20% part. Again, in case of fourth house, SSC could not realize 1 month rent due to the death of the tenant, and SSC satisfied the conditions. So therefore you can consider it as a unrealized rent. Unrealized rent means the rent which could not be realized by the SSC is called as a unrealized rent due to some reasons. So here reason is why the rent is not realized, because of the death of the tenant. And you can deduct, or means you can consider the unrealized rent if SSC satisfied the conditions. So here SSC satisfied the conditions. There are a lot of conditions related to unrealized rent which I have explained in the beginning itself. So if SSC satisfied the conditions related to unrealized rent, then you can consider it as unrealized rent. Otherwise, it will not be considered as a unrealized rent. So here in case of fourth house, there is a vacancy period 1 month as well as 1 month of unrealized rent. These 2 points to be taken into consideration while calculating rent received in case of fourth house. Next point, the municipal taxes levied at a 10% of municipal value amounted to rupees 50,000. So here the municipal value is 50,000 and another point is the municipal tax is 10%. See, this municipal value 50,000 is for the entire house, for the big house, and you have to divide it for the particular part while you are calculating the income. If it is for 30%, then you have to take only 30% of the municipal value. If you are calculating for 20% part, then you have to take only 20% of the municipal value. Not only in case of municipal value, even in case of parent as well as a standard rent. Even municipal taxes, the 10% of municipal value means 50,000 into 10%. Then you have to take it for the particular part. If it is for 30% part, then 50,000 in 10% into 30%. So that's why how the municipal tax you have to calculate. It is given for the big house, so you have to divide it for the particular part. Next point is, he borrowed rupees 5 lakh at a 10% per annum for the construction of this house on 1st October 2015, which was completed on 31st July 2018. The loan outstanding as on 1st April of the previous year, rupees 4 lakh. So now the point is, SSC borrowed rupees 5 lakh as a loan for the construction of this house. This house means big house. For the construction of this entire house, SSC is borrowed the loan of rupees 5 lakh. And loan has been borrowed on 2015 in the month of October and construction completed in the month of July 2018. Now with the help of these details, you have to calculate the interest on loan for the 1/5 of pre-construction period interest as well as interest on loan in previous year. Point is here, the loan is borrowed for the big house, and while you are giving the deduction under section 24, you have to give the deduction partially. Partially means while you are giving the deduction for self-occupied part, you have to take only the 25% part. And while you are giving the deduction for let out property of 30% part, then you have to take only 30%. And again for the last property, there also you have to take only 20%. The 5 lakh loan is borrowed for the construction of the big house. So while you are giving the deduction, you have to give the deduction only for that particular part. So procedure of calculation is the same, but proportionate deduction, not full amount is liable for deduction under section 24. Only that particular part, the proportionate amount is liable for a deduction under section 24, since the loan is borrowed for the construction of this particular entire house. So that is about the problem. So we will solve it as one by one. So before starting the assessment of each house properties, let me calculate the interest on loan first, because the loan is borrowed for the construction of the big house. So entire for the 5 lakh rupees has been borrowed for the construction of the big house, which is applicable for all the properties. So therefore, in the first I will calculate interest on loan. Later I will calculate the incomes of each properties. So we will start with as per the provisions of interest on loan. First one, 1/5 of pre-construction period interest, and another is the interest on loan in previous year, which comes under deduction under section 24. So first part, 1/5 of PCP interest. Equation is loan amount into interest into PCP by 12 into 1 by 5. Substitute the values. Loan amount is a 5 lakh. The 5 lakh he borrowed. The 5 lakh is the loan amount. 10% is the rate of interest. And PCP, pre-construction period, the duration which has been taken by the SSC to construct the house is called as a pre-construction period. Here total 30 months. That interest paid in that particular duration is called as a PCP interest, pre-construction period interest. How to calculate? With the help of the date on which the loan borrowed and with the help of the date on which the construction completed. So here loan borrowed is on 1st October 2015 and construction completed on 31st July 2018. With the help of this, we have to calculate PCP. The PCP starts on the date on which loan borrowed, means here on 1st October 2015, end on 31st March prior to the date on which the construction completed. So here the construction completed in the month of July 2018. So we have to calculate the interest till March only, March 2018. The prior month to the month of the construction completed in the previous year. So July month construction completed, till March only we have to calculate the interest. So that is the PCP. So here it is from 1st October 2015 to 31st March 2018, 30 months. Not till 31st July, till 31st March only we have to calculate the interest or the PCP. So total 30 months duration of pre-construction term, or that is considered for the interest payment for the calculation of interest. So duration of PCP is 30 by 12 and into 1 by 5. 1 by 5 means it has to be paid in 5 equal annual installments. So total interest for the PCP is a 25,000. Again, this is for the big house. For the entire house, interest on loan in that first part, 1/5 of PCP interest is a 25,000. The second part, interest on loan in previous year. It's with the help of outstanding loan in previous year into interest. So outstanding loan for the previous year rupees 4 lakh due in the beginning of the previous year is a 4 lakh. 4 lakh into rate of interest is a 12%. 48,000 is interest on loan in the previous year. See, this 25,000 and this 45,000 is a interest on loan for the previous for that particular house, and which has to be divided into 4 parts. So while you are calculating any particular part, either 25% or 30% or 20%, you have to take only that much part. That part only means here 1/5 of PCP interest is 25,000. 25,000 into 25% while you are calculating self-occupied property. Next 25,000 into 30% while you are calculating 30% let out part, and another is 25,000 into 20% while you are calculating 20% part. So in that way you have to apply deduction under section 24 for interest on loan. So that's about interest on loan. The remaining part I will explain in another class. Thank you very much.